What?
Assalamualaikum and hi. Today our group will present about Takaful. But first and foremost, let me tell you what is Islamic finance. Islamic finance is a type of financing activities that must comply with Sharia law, which means it complies with rules and regulations that stated in Al-Quran, As-Sunnah, and further explanation of rules by Islamic scholars. The concept can also refer to the investment that are permissible under Sharia. Principle of Islamic finance. First, prohibition of interest riba. Second, avoiding investing in businesses that involve in prohibited activities. Third, avoiding maisir, speculation. And lastly, steering clear of uncertainty-based transaction, qara. Now, let's move to the differences between Islamic finance and conventional finance. Value proposition. Value proposition is the company's overall marketing strategy. It can be presented as a business statement that the company uses to summarize why a consumer should buy a product or use a service from us rather than the competitors. In context of value proposition, Islamic finance aiming on maximized profit based on Sharia and legislative requirements. Financial justice is a requirement that helps Islamic finance function in a Sharia-compliant way, while conventional finance aiming on maximized profit only based on legislative requirements. Next, for Islamic finance, profits are shared between bank and depositors with a pre-agreed ratio, and the profits are not guaranteed. While for conventional finance, depositors are guaranteed a predetermined rate of return, which is interest.
The structure comparison between Islamic finance and conventional finance. In Islamic finance, it consists of sources of funds, pool of funds, application of funds, Islamic banking contracts, income from activities, and distribution of income. For conventional finance, the first structure starts with investors give capital or receive customer deposits and then invest them for a return. The bank will receive interest from their investment and the interest received will be distributed accordingly. The second structure is when customer requests for loans. The bank will borrow into bank funds and lend the funds at an interest rate. So, the customer will be charged with the interest plus the principal. The operational mechanisms between Islamic finance and conventional finance. For deposits, the Islamic financial institutions offer deposit products based on two contracts, which are qard and mudharabah. Under qard, current accounts are offered under this contract, where the risk of the fund lies with the bank, and no additional benefits provided to the clients. Under mudharabah, it is a type of partnership where the client's funds are invested in various business activities and returns are shared between the bank and the client based on agreed profit sharing ratio concept. For conventional finance, the conventional financial institutions accept deposits on the basis of loan for all types of deposit accounts, including savings account and current account. In addition, the conventional financial institutions invest the deposits of the client to non-Sharia compliant business activities and subsequently they earn non-Sharia compliant returns as well. For lending or financing, in Islamic finance, it offers lending facilities to their clients to fulfill their business requirements on the basis of following contracts, depending on the requirement of the client. In conventional finance, the conventional banks offer lending facilities to their clients to fulfill their cash requirement on the basis of loan contracts, where the relationship between the bank and the client is lender and borrower.
Takaful. Under this topic, we will discuss about the definition, operational mechanism, principle of Takaful, model of Takaful, and benefits of Takaful. Definitions of Takaful. Takaful is an Islamic insurance firm in which participants contribute money to a pool scheme in order to guarantee each other against loss or injury. Takaful is based on Sharia, which explains how it is the duty of individuals to cooperate, protect each other, and promote value of tabarruk and taqwa. Operational mechanism. Takaful participants pay contribution and operate undertake to manage the risk. Contribution paid by participants are credited into the Takaful fund. All contributions go to a common pool of funds which will be used to compensate Takaful participants in the event of loss. Principles of Takaful. Policyholders cooperate among themselves for their common good. Every policyholder pays his subscription to help the standing assistance. Losses are divided and liabilities spread according to the community pooling system. Uncertainty is limited in respect of subscription and compensation.
Next, I would like to elaborate the benefits of Takaful. First, the Takaful Fund is a non-profit fund basically aims to achieve cooperation among its participants. Second, Takaful in all its products, transactions, and investments are subject to the provisions of the Islamic Sharia. Next is models of Takaful. The models consist of Mudarabah Takaful, Wakalah Takaful, and the last one is hybrid of Wakalah and Mudarabah. Mudarabah Takaful can be defined as a profit and loss sharing principle applied to a business commercial contract between the party that provide the fund and the party that manage the business. The contract will define the profit of the Takaful business and the ratio to be shared between the two parties, such as 50-50. Wakalah Takaful. The term Wakalah in Arabic means agency. Therefore, under the structure, an agency relationship is agreed between two parties to conduct a certain business undertaking. The model describes an agency agreement between the operators acting as the agent or wakil to the participant. The principal will manage the participation of the latter in a variety of Takaful products provided by the operator. Takaful hybrid model is a combination of Mudarabah and Wakalah models. Under this model, a relationship between the operator which combines the role of entrepreneur or mudarib as well as the agent or wakil of the participant. By this arrangement on the part of the operator, an agency fee can be remunerated as upfront charges from the Takaful fund. At the same time, we will have the right to profit sharing or returns on the investment of the Takaful fund in accordance with the Mudarabah contract.
The last subtopic that I will present is the differences between Takaful and insurance. Takaful and conventional insurance companies share the same objective of providing protection to you, your loved ones, and your valuable possession. The main differences between conventional insurance and Takaful is that the former is a risk transfer model, whereas the latter is a risk sharing model. In Takaful, risk transfer mechanisms are based on mutuality. Hence, the risk is not transferred but shared by the participant. Next, a contract type for Takaful is a combination of a tabarruk contract. For the relationship, there is no insurer-insured relationship between the Takaful operator and the participant. Next, we continue with the profit. It is belong to the operator and participant and is accordingly returned to them. Lastly, for the investment in fund, it must be invested in Sharia-compliant instrument whereby it can be only invested in net interest-bearing, for example, riba-free instrument. For the conventional insurance, a risk transfer mechanism whereby risk is transferred from the policyholder, the insured, to the insurance company, the insurer, in consideration of an insurance premium paid by the insured. For the profit, it is belong to both the shareholder and the with-profit policyholder. Contract type that been used in conventional insurance is a contract of exchange or known as sale and purchase between the insurer and the insured. For the relationship, there is a clear insurer-insured relationship. Lastly, investment in fund. In conventional insurance, there is no restriction on the investment in fund.
In conclusion, Takaful is an insurance scheme that is Sharia compliant. Takaful in Malaysia and elsewhere is relatively young and when compared to other sectors of the financial industry, but it has enjoyed robust growth. However, despite the robust growth, the penetration rate for Takaful in Malaysia and elsewhere remains small, and this indicates that there is significant opportunity for future growth. Furthermore, there are still challenges that need to be faced by Takaful industry in Malaysia and elsewhere in order to expand further. Last but not least, Takaful is a choice. It can be your needs or wants, depends on yourself. However, we would like to encourage you to subscribe a Takaful plan for your protected future. You don't buy Takaful because you are going to die, but because those you love are going to live.